Most people think retirement is the finish line. You work hard, save a little, pay your mortgage, and one day, freedom. No more alarms, no more meetings, just peace. But what if I told you that freedom might only last 5 or 10 years, then the money runs out? Nearly 90% of retirees either outlive their savings or drastically cut their lifestyle in the last years of their life. And the most terrifying part? It's not because they didn't save, it's because they didn't plan. Here's the truth. Retirement isn't just about saving money. It's about making that money last, grow, and protect you for 2 or even 3 decades. So if you're relying on just a pension, a 401k, or whatever's in your bank account, you're probably walking straight into a financial trap. In this video, we're going to break down exactly why this happens to so many people. And more importantly, how you can avoid ending up broke at 75. The first mistake is brutally simple. We underestimate how long we'll live. If you're 65 today, there's a strong chance you'll live into your 90s. And women, many will pass 95. That's not 10 years of retirement, that's 25 or even 30. Your money has to last longer than ever before in human history. Let me paint a scenario. Imagine you retire at 65 with $300,000 in savings. You withdraw $30,000 a year to live modestly. By year 10, your nest egg is gone. And if markets perform poorly or inflation spikes, that timeline shrinks. What happens next? You rely on Social Security alone. And in the US, the average Social Security check is around $1,800 per month. Can you live off that? Can you handle a medical emergency on that? For most people, the answer is no. The second killer? Inflation. It quietly erodes your purchasing power year after year. A coffee that costs $3 today might be $6 in 20 years. If your savings aren't growing at a faster pace than inflation, you're losing money, even if the number in your account looks the same. And let's not forget taxes. Many retirees forget that withdrawals from traditional retirement accounts are taxed as ordinary income. So that $30,000 withdrawal? It's not really $30,000, it might be $24,000 or less. Then there's healthcare. Most retirees don't budget for it properly. A report by Fidelity estimates the average retired couple will need over $315,000 just to cover medical expenses. That doesn't include long-term care, dental, or unexpected illnesses. One hospital visit can wipe out years of careful saving. And what about emergencies? Roof repairs, car replacements, helping adult children. These unplanned expenses can quickly derail even the best budgets. Despite all this, millions of people walk into retirement with no plan other than, I hope it's enough. Hope is not a strategy. In the next part, I'll show you exactly how the wealthy protect their retirement, and how you can use the same tools and mindset to build a retirement plan that lasts, even if you're starting late. The wealthy don't rely on luck when it comes to retirement. They rely on systems, strategies, and a deep understanding of how money really works. And the good news, you don't need millions to copy what they do. It all starts with this principle. Your retirement income must be as reliable as your working income once was. If your paycheck stopped tomorrow, would you be okay? That's exactly how you need to think about retirement. Except now you are responsible for writing the checks. One of the smartest moves the wealthy make is building multiple streams of income that don't depend on their labor. They invest in assets that pay them whether they're sleeping, traveling, or just enjoying life. Dividend-paying stocks are a perfect example. They generate cash flow, often every quarter, and when reinvested, they snowball. Let's say you own $500,000 in a diversified dividend portfolio paying 4%. That's $20,000 a year without touching your principal. Add Social Security, and you might already cover your basic living costs. But here's the secret. Wealthy people don't just collect dividends. They reinvest them for decades until those payments alone become self-sustaining. It's not about buying a stock. It's about building a machine. Next up, real estate. It's not just about flipping houses or being a landlord. Rental properties, especially in stable markets, can generate steady, inflation-protected income. because rent tends to rise over time just like costs. Picture this. You buy a duplex in your 40s, rent it out for 20 years, and by the time you retire, the mortgage is paid off. Now it brings in $2,000, $3,000 a month net. That's income for life. Some wealthy retirees also use annuities, controversial but powerful when used right. Think of an annuity as a personal pension. You give an insurance company a lump sum, and they pay you a guaranteed income for life. Used wisely, it reduces risk and adds stability. Another key strategy? Spending from growth, not from capital. Instead of withdrawing $40,000 a year and watching your portfolio shrink, they aim to withdraw only what their portfolio grows. That way, the principal stays intact and they don't outlive their money. But even with income strategies in place, the wealthy understand sequence risk, the risk of bad market returns early in retirement. If the market crashes right after you retire and you're forced to sell assets to pay bills, you lock in losses that can devastate your portfolio forever. To combat this, smart retirees build cash buffers, 1 to 3 years of expenses in cash or ultra-low-risk instruments. So if the market crashes, they don't panic. They wait it out, let their investments recover, and protect their future. And here's something few people consider: international diversification. Wealthy investors don't keep all their eggs in one economy. They hold assets in different countries, currencies, and markets to reduce risk and capture global growth. They also plan for taxes. They don't wait until retirement to realize that every withdrawal from their 401k or IRA will be taxed. They start moving money strategically, using Roth conversions, tax loss harvesting, and smart withdrawal order. This alone can add years to the life of a portfolio. But it's not just about money. Wealthy retirees have a retirement lifestyle plan. They know what they want to do, where they want to live, and how much it'll cost. They don't leave it to chance. They design it, adjust it, and stay in control. And the best part? You don't need a 7-figure portfolio to do the same. You just need time, discipline, and the right strategy. In the final part of this video, I'll show you how to build your own bulletproof retirement plan, even if you're starting with very little. Stay with me, because this next part could change everything. Let's get practical. You don't need to be rich to retire well. You need a clear, actionable plan that balances income, growth, and protection. The first step is mindset. Most people approach retirement backwards. They ask, how much do I need to save? But the right question is, how much monthly income do I need to live the life I want? And how do I build reliable sources to generate it? Let's say you estimate needing $4,000 per month. Subtract Social Security, maybe $1,800. Now you have a gap of $2,200. Your entire retirement strategy should focus on building assets that cover that gap without depleting the core portfolio. How do you do that? Start with the 4% rule as a baseline, not a guarantee. This rule says you can safely withdraw 4% of your portfolio annually, adjusted for inflation, without running out of money for 30 years. So to cover a $2,200 monthly gap, or $26,400 per year, you'd need around $660,000 invested. But here's the twist. Instead of relying only on growth, build a layered retirement income strategy. Layer 1, fixed income and guarantees. This includes pensions, annuities, or Social Security, your stable base. It should cover your non-negotiable expenses, housing, food, healthcare. Layer 2, passive income. Dividends, rental properties, R8s. This layer should give you predictable, tax-efficient cash flow, ideally enough to fund your lifestyle without touching your principal. Layer 3, growth and flexibility. ETFs, index funds, and globally diversified portfolios. This layer protects you from inflation and helps grow your wealth over time. You withdraw from it only when needed or in good market years. Now let's talk automation. One of the biggest mistakes retirees make is emotional decision-making. Selling during downturns or spending too fast. Use tools like automated withdrawals, dividend reinvestment plans, and rebalancing. They remove emotion and keep your strategy intact. But a good plan isn't just financial. It includes health planning too. Get long-term care insurance early if it fits your profile. Designate medical and financial powers of attorney. Make sure your estate plan is in order. Wills, beneficiaries, trusts. These aren't fun conversations, but they protect everything you've built. Next, reduce risk through downsizing and geo-arbitrage. Many retirees free up hundreds of thousands by selling their large homes and moving to lower-cost areas, or even other countries. Places like Portugal, Mexico, or parts of Southeast Asia offer high-quality healthcare, safe living, and low costs. Geo-arbitrage can instantly extend your retirement runway by 10 years or more. And don't forget taxes. A tax-efficient withdrawal strategy can make your money last years longer. Withdraw from taxable accounts first, then tax-deferred, then Roth. Harvest losses, convert in low-income years. Plan every withdrawal like it's a chess move. Now, here's the final and most important part. Start today. Doesn't matter if you're 30, 45, or already retired. Every dollar you put to work now is a soldier in your future financial army. Cut unnecessary spending, increase contributions, learn about the tools the rich use and copy them. Because the truth is simple. Running out of money in retirement isn't a fate, it's a result. A result of poor planning, fear-based decisions, or doing nothing. But the opposite is also true. You can build a retirement that gives you freedom, dignity, and peace of mind if you start building it intentionally. So now that you know what's really at stake and how the game works, the next move is yours. Take control before it's too late. And if you found this helpful, don't forget to like and subscribe for more videos like this. Drop a comment if you want a deep dive on retirement investing, dividend strategies, or low-cost geo-arbitrage options. And remember, the sooner you start, the sooner you stop worrying.